specific financial product hands out free cash, flights, and points, while generating billions of dollars in bank profit every year. Billions of people actively apply for this product and carry it in their pockets, viewing the points as a voluntary benefit rather than a calculated risk. Consider Daniel's strategy. He uses a 2% cashback card for every purchase, pays his balance in full every month, and avoids all debt to maximize his rewards. Daniel follows the standard advice for responsible users. Use the card for everything and collect the free money. By the end of the year, Daniel has earned $240 in cash back, a figure that feels like a clear financial victory. However, a direct comparison of Daniel's total spending shows his year 2 expenses were $1,800 higher than the previous year. Small upgrades and extra dinners, justified by the points they earned, led to a net loss of $1,560. This raises a difficult question. How does a system giving away cash successfully manipulate a responsible person into spending significantly more than they planned? Human spending is governed by the pain of paying, a cognitive friction experienced when we physically part with money. Handing over physical cash triggers a small sting in the brain. This hesitation acts as a natural brake pedal, forcing us to consider if a purchase is truly necessary. Swiping a card removes this physical sensation of loss, turning the transaction into a frictionless digital event that the brain evaluates differently. Adding a reward to that swipe completely reverses the emotional impact. Instead of a sense of loss, the user feels a small, immediate win with every purchase. Daniel's $18 spending increase happened because the card disabled his brain's internal financial braking system. To find where the free reward money originates, we have to follow the flow of a standard credit card transaction. Every time you swipe, the bank takes a cut of 2 to 3% from the merchant as a processing fee. Merchants cover this fee by raising the price of every item on their shelves, creating a hidden tax that everyone pays at the register. The bank collects this inflated price, keeps a portion for themselves, and returns a fraction of that hidden tax to you as a reward. This system provides a partial refund on an invisible cost the consumer has already covered through higher sticker prices. Rewards cards carry significantly higher interest rates than cards without perks, serving as the bank's ultimate safety net. Banks rely on the fact that life is unpredictable. They know that a certain percentage of responsible users will eventually face an emergency and carry a balance. Interest rates north of 20% can incinerate years of accumulated points in just a few weeks of carried debt. The model remains profitable as long as a statistical minority of users stumble, funding the points for everyone else through interest charges. Banks design rewards specifically to increase the frequency and total volume of consumer transactions. Billions in payouts only exist because the math of increased spending and merchant fees is guaranteed to favor the bank. Utilizing these cards save your total annual spending rather than your points balance. If your spending rises more than your cashback, the card is a net loss. Rule 2. Before any non-essential purchase, perform a cash test. Ask if you would still buy that item at that price if you had to hand over physical paper bills. Finally, recognize that carrying a balance is a total failure of the rewards math, signaling that the trap has successfully closed. Daniel lost money because the friction of spending was invisibly engineered out of his daily life. The bank won by ensuring he focused on a small feeling of winning while ignoring the $1,800 leaving his account. The most effective financial traps in the modern world hide in plain sight as gifts.